All right, welcome everyone to episode 3 of the Plena Wealth Advisors podcast. Here again with me in our sunny Vancouver office is Clark Linton. Clark, how are you today?
I'm doing great. And you, Jay?
Very well, very well. And up in what looks like sunny Kelowna, Craig White. How is springtime coming along up there?
Beautiful in the Okanagan. Yeah, I think we've got 14, 15 degrees and the snow is melting. So I think like a lot of people, we're looking forward to spring here in the Okanagan. Absolutely.
So again, our goal of this podcast is just to provide a window into our conversations, talking about the market, the economy, anything else that might affect our offerings to clients. We hope everyone enjoys it. And without further ado, there's lots to talk about today. So with all that's happened in the banking sector recently, obviously with Silicon Valley Bank, Credit Suisse more recently, there's just an abundance of things directly affecting client portfolios, directly affecting the markets. And, who would have thought at the start of this year, we're talking about bank runs, which, were really thought to be a thing of the past. In the 1920s, they were quite common, but we haven't really seen anything like this at all recently. So most recently we saw, or I guess the thing that kicked off the cascade of events was Silicon Valley Bank a few weeks ago. Can either you kind of give us the high level overview of what happened in Silicon Valley Bank's case?
Yeah, maybe I'll tackle that one. It's a great intro probably to what's top of mind for a lot of investors these days, and you can really take it a lot of directions here, and probably for the sake of time and for the sake of the audience here, try to keep it relatively simple from a top-down level here. And we've sent out an update last week discussing this, and I'd say at the top of the list of what got us to this point, in specific with Silicon Valley, is really a mismanagement of the bank's assets. And what does that mean for those who are tuning in today? If you kind of look at the simplicity of a bank, what they do is they take in deposits, and that becomes a liability on the bank's balance sheet. At some point, they have to honor that back to that same depositor. At the same time, when they take in those deposits, they extend that in various forms of credit to manage their business for investment banking purposes, et cetera. And essentially what Silicon Valley did, they took in a tremendous amount of deposits over the last number of years, but the nature of their business, which based out of California, technology-based, they're large deposits that are venture capital type deposits. They took in a tremendous amount, as I said, and what they did within their balance sheet as part of their assets to enhance the return for Silicon Valley Bank shareholders, they extended their credit. In other words, they lengthened out their duration to earn a higher rate of return. You get compensated for the longer you extend the maturity on a bond. With the increase of interest rates over the past year, which we've talked about in the last two podcasts, they essentially got caught. Interest rates went up and those bond prices went down. At the same time, when the technology sector was slowing down, those people were asking for those deposits back. And essentially, Silicon Valley was forced to sell assets at a loss to honor those deposits. And once that kind of spiraled and you started to get some momentum behind it, you essentially had what you referred to as, Jay, as a run on the bank. A lot of people refer to this as a banking crisis, a financial crisis. From our perspective, it is a mismanagement of a bank and a handful of other banks that are similar in nature on their business. So that's
just to underscore that a little bit. I think the reach for yield, as you allude to, the mismatching of maturities. So the bank's investing in longer term bonds that mature in 10 plus years, when their depositors are expecting those assets to be returned, in the very short time frame, which just so happens to be the part of the bond market that is most exposed to rising interest rates, as we saw last year, right?
Yeah, it wasn't as if they were invested in toxic assets. on Silicon Valley. In fact, they were invested in treasuries. So I think that's why you saw over the last 10 days, you've seen FDIC, you've seen the Treasury, you've seen the US central bank step in and backstop those deposits, because it wasn't the toxic assets that was at risk, it was duration risk, as you talked about, Jay. So, some people referring this as a bailout. Certainly it's not, because shareholders of Silicon Valley were not bailed out. In fact, the shareholders have essentially been eviscerated. The depositors have been backstopped.
I think two really good points there, Craig. This is not a bailout of a bank. I mean, CEOs, senior management are losing their jobs. Shareholders have been wiped out. I think the second point there, and you mentioned, this is not an investment in toxic assets that had a whole bunch of contagion and intermingling between global banks. Like the financial crisis. We have been asked over the last couple of weeks, is this another 2008, 2009? I think that's one of the key differences, is this is not necessarily involved with toxic assets that are worthless.
Yeah. So who's to blame for all this? Where do we point our fingers at?
Well, I think, Craig did a good job really pointing out where the primary responsibility for this is, which is the senior management of the banks here. I mean, this is a completely mismanaged bank. But I think it would be wrong to say that's really the only, parties that are at fault. I think there's two other areas at least that we can look at. We've got bank regulators for a reason. Bankers are going to take on risk. They're going to grow. Some are going to grow their banks too quickly, et cetera. And that's why we have bank regulators in place. I think the other thing that goes unspoken here a little bit is, some of this can be pointed to depositors, not managing their risk, as much as they should have as well.
Yeah, I think when you look at the, size of some of these, the average deposits, the uninsured deposits that were sitting on Silicon Valley's bank statements, and the average, startup Silicon Valley, tech company that maybe raises $100 million to try to, develop some new app or solve some sort of problem in the way that Silicon Valley does, for them to take that whole $100 million and simply just put it in a bank account when they've got to meet payroll, they've got to, pay for all of these expenses, excuse me. There's some irresponsibility happening there, and whether they don't know any better, whether, Silicon Valley Bank is to blame for not steering them in a better direction to make sure more of those deposits are covered by insurance. It's hard to say who's to blame, but it definitely falls on, some of their shoulders, I don't know, equally, but very different in terms of the, source of the problem, where, we look back to 2008, 2009, you certainly had some, nefarious activity going on. I think this was, maybe some poor risk management and, some uneducated, venture capital CEOs, not recognizing risk, tough to exactly apportion the blame to each party. But Craig, any thoughts on your end?
I think the conversation around insured relative to uninsured deposits is important here, because again, if those who are familiar with FDIC, Federal Deposit Insurance Corporation, which is the equivalent of CDIC here in Canada, any deposit up to $250,000 in the US is insured federally. Uninsured deposits, as you said, Jay, is anything above that amount. And by the very nature of Silicon Valley's large deposit base, that's where they ran into 95% of their deposits were uninsured. And again, the other component here, and I think, Clark, you were going in that direction. I think you have the management at the top, that's to quote unquote blame. And then from there you have regulations. But step down from there, you probably have, the central banks, in our opinion, that were somewhat behind the curve on this inflationary theme that they said was transitory, to the point where they've had to step on the brakes and raise rates 9 times. That doesn't excuse the mismanagement of Silicon Valley. But what happened is all those technology companies, their cost of capital went up. So they were forced to come in and say, give me back X percentage of my dollars, which is higher than that $250,000 limit. And it kind of snowballed from there, as I led off with. So I think there's a number of different layers here that, again, you can point fingers at. But at the top, again, as Clark said, it's mismanagement.
Yeah, and I'll touch on both those issues quickly. If you look at the tech companies and depositors, I mean, this is really on the CFO and the oversight from the CEO. If you are taking, if you're $100 million venture company, prudency just shows as treasury management, you don't put that deposit in a mid-size regional bank. That treasuries are for. That's what deposits at larger banks are. Spread your risk around, and that didn't happen with a lot of these cases. I think, though, over and above the depositors, I think, Craig, you touched on, the Federal Reserve and maybe their mismanagement and inflation a little bit. But I think this really goes back to bank regulations in general. And, bank regulators, we have them in Canada. They're in the States, they're in Europe. They're in place for a reason, as I mentioned a few minutes ago. And, managing the US banking system where they've got thousands of banks, I just cannot imagine how difficult of a task that is. I think in Canada, between the 5 banks and some of the smaller banks, we've got 30 banks that our regulator manages versus 3,000 plus in the States. And, they've got immense power. They can come into these banks and see some of these issues, and they can force change, including forcing these banks to raise capital at a time where they might not want to raise capital. And, take a step back and look at Silicon Valley Bank. I mean, even before some of these problems started to exist last year, and this wasn't just last week or 2 weeks ago, it was last year. This was a bank that had quadrupled its asset base and its deposit base in the last 5 years. Huge growth. As you mentioned, it was a bank that was almost exclusively focused on one sector of the economy, which was technology, at times a very cyclical industry. The 94% of uninsured deposits, just that alone, even in good times, should have caused regulators to have a little bit more oversight on this bank on an ongoing basis. Now, if you go back to last year, and this is easy in hindsight, but from a regulation point of view, this should be, on their radar. A lot of people weren't aware that they went last year, this is Silicon Valley Bank, to the Federal Home Loans Bank program, which is really the second lender of last resort next to the Fed, and borrowed $15 billion to shore up their balance sheet as they started to see some of these losses. Beginning of last year, they had zero borrowed from that bank. I mean, to see that happen all in 1 year, part of the reason that happened last year was that sector risk we talked about, which was the money coming into these venture companies basically evaporated last year with the tech slowdown. A lot of these deposits went out. And the other thing, the bank didn't have a senior risk manager or risk officer for the last year.
Which is so amazing, right? Like what a critical position to be in at a bad time.
Well, and that was, I would imagine a bank losing a senior risk officer, or their risk officer would have to be disclosed, or would be aware by the Federal Reserve. You look at some of these loan losses that have caused this run on the bank. A lot of those happened last year, and they're disclosed in their SEC filings. So, where was the regulator in this? And I think I think this will be a huge revisit of regulation, particularly in the U.S. banking system.
I think I'll just say, without the regulators, yes, they carry some blame, but you also look at the research analysts. I mean, across the board, they had buy ratings on the stock all the way up until basically it was started, exhibiting serious signs of trouble. The credit rating agencies, Moody, had them investment grade, all the way up until the bank seized their books. So it all becomes very obvious in hindsight, as it always does. But there's a lot of blame to go around. Well,
an interesting thing too that I'll add in here, and again, Clark was touching on the $15 billion of losses. One thing what's critical here is that a lot of these banks in the U.S. are not required to market the value of these securities they're invested in. Without getting into the weeds there, if they were buying a treasury, let's say at $100 par, it's your expectation they hold that to maturity and they get their $100 back. They reported that on their balance sheet as always at $100 or par. But as interest rates went up, as we talked about, bond prices went down. So that same bond could be traded at 92 cents on the dollar, yet they'd still mark that to 100. That's a lot different than here in Canada, where we as investors, the Canadian financial institutions, are required to market on a daily basis the value of their underlying portfolio of securities. Silicon Valley was not reporting it mark to market. They're reporting it on maturity. That's a big difference. That's significantly different than what's required here in Canada, as I noted. And they got caught.
So we also saw since then a couple other banks which seem to have also unique risks associated mostly with cryptocurrency, with regional banks, and this certainly sent ripple effects through the rest of the banking sector and even affected Canadian banks to some degree over the last couple of weeks. But I think most recently we then saw the forced merger or acquisition of Credit Suisse from UBS, which seemed to have been orchestrated by the Swiss central bank. So curious how that kind of relates to what happened with Silicon Valley. What are the differences? What should we be thinking about with that one?
Yeah, I think that's a good point, Jay. Credit Suisse obviously is not a small regional bank in the U.S., although SVB is not small in nature or size, but Credit Suisse obviously far larger. One of the 30 globally, too big to fail banks. So this is of significance. I think though that potentially what the market has wrong, at least the headlines have wrong, is that Credit Suisse's problems were not a result of this contagion that we saw potentially last week. Credit Suisse's problems go back years. I mean, in the European banking system, they've been the weakest link for going on 2 decades as far as the larger European banks. When we invest in things and think about some of the banks that we own, best managed in the world, Royal Bank, JP Morgan, et cetera, we always like to say, when we invest in a stock over the long run, we like to see stock performance go from the lower left to the upper right. And you look at those 2 banks as examples, performance has been good, which is a reflection on their fundamental strength. If you look back over a 20-year period with Credit Suisse, just the complete opposite with their stock. And it should be a reflection that these problems have existed with the banks for years. They've made a huge number of missteps, both on the management side, reputational risk from some compliance issues they've had. I mean, just to rattle off a few, 2014, I think 8 or 9 years ago, they were involved with, allowing purposely a lot of their depositors to evade U.S. taxes. They were reprimanded and charged billions by U.S. regulators for that. 2019, 5 years later, they were caught up in the forget the name of the Chinese coffee firm, Luckin, yeah. Accounting scandal as well. They were the underwriter, overlooked a lot of that accounting fraud. That cost them from a reputational point of view. A year later, the CEO had to resign because there were some spying scandals amongst their senior executives. This goes on and on. I think 2021, a large hedge fund in the U.S. failed, Archegos Capital. They took a $5.5 billion write-down Credit Suisse, and an external review said that they purposely allowed huge risk to be taken at that hedge fund. These issues go on. And I think the thing that really was the straw that broke the camel's back for them was last year, this goes back a year, their finances were in jeopardy. A lot of social media speculation about the failure of the bank, which caused large deposits to leave to an extent that it was extremely difficult for them to remain profitable. And last month they released their 2022 earnings, and the largest loss they've taken since the financial crisis. And so these problems didn't start last week; they've been ongoing for the last decade or two. So it's a huge difference. And I think what happened last week was that the media asked the largest shareholder at Credit Suisse, which I believe was the Saudi National Bank, their chairperson, would they invest more in Credit Suisse? And his answer, out of the gate was absolutely not. And the media these days, they like to focus on what the media or what people want to hear, and that's what they relayed in the media. It I guess freaked out or scared a lot of people, especially going through what we last week seeing Silicon Valley Bank. And what the media didn't focus on was the reasons why they weren't going to invest any more money. So later in his comments, which the media didn't play, he basically said, hey, look, if we go beyond our 9.9% holdings right now, we really can't, because at that point, it becomes a regulatory compliance political issue. But everybody wanted to focus on absolutely not. We're not investing more in this bank. And I think that was the final straw for Credit Suisse. Final thing I'm going to say is, a positive out of that is we just talked about some of the regulatory failures in the States. The Swiss government over the weekend did exactly what they should do from a regulatory perspective. They stepped in and saved this bank by forcing a merger with UBS to avoid a bigger problem like we saw with Silicon Valley Bank.
Yeah, again, it seems just like a, gross mismanagement of risk and of, their underlying business on various levels and for many steps along the way that, most investors should at least have been aware of if you were owning, Credit Suisse stock. None of this was a surprise to you. And unfortunately, it's going to lead to, more concentration within the Swiss banking segment. And less options for, depositors, less options for, those seeking funding. And same goes in the US, where ultimately I think you're going to get, more concentration of asset flow towards the bigger banks, which is something we've already seen. But I'm thinking, for the average person, and obviously everyone certainly that we work with has, investments, assets in various banks. What's the takeaway that that we can learn from this, and how do we kind of navigate the banking system moving forward?
Well, let's kind of maybe sum up what we just talked about for whatever the first 10, 15 minutes of this podcast. There's a common theme amongst these banks. It's A, they've been in structural decline. B, they're mismanaged. C, the nature of their business is more volatile or more cyclical. D, there wasn't a lot of regulation. So, the first three are likely are going to take care of themselves, which they've unfolded over the last couple of weeks. In Credit Suisse case, it's been for 20 years, in particular, the last 3 years, if you look at the stock price. I think the big thing that's going to change in probably more south of the border is going to be tighter regulations. And just even today, you had Jerome Powell, head of the Federal Reserve, coming out saying, going forward, they're going to again tighten up the regulation on the U.S. financial system. I would probably argue that's more geared towards the regional financials, which are smaller in nature. For our clients, for investors here in Canada, the strength of the names that Clark mentioned, the strength of the Canadian financial sector is significantly different than the names that we just talked about. The nature of the business is far more diverse. They're far more capitalized. They've got liquidity ratios that's, significantly stronger than a lot of these names that we've talked about. So, at the margin, I'm going to say that for our clients, for investors that have exposure to Canadian financials, whether that's in portfolios, certainly through pension plans, through endowments, they have exposure. It creates short-term volatility, but at this time, and I think you've even heard it from a lot of the bank analysts and CEOs of these same companies, that they don't see any risks looming at all. So it's.
Yeah, I'll add a couple things to that. And I think both sides of the coin. I think it's important to point out that the regional banks in the United States, Silicon Valley is not representative of the quality of the management of those banks. I would argue that probably north of 90% of those banks are managed quite well. And the other side of the coin, though, is, look back, and I think we have to be cognizant that Silicon Valley Bank, the two crypto banks, and Credit Suisse will not be the only failures likely that come out of this current environment of rising interest rates. Look back to the late 80s, early 90s with the savings and loan crisis, thrift crisis in the United States, where I think it was north of 1,000 thrifts failed, a third of the thrifts in the United States. I mean, similar to regional banks to some degree. I would argue, though, that the financial system and these banks are managed far better with greater oversight than there was 30 years ago. But again, the other side of the coin is, let's not assume that, we're not going to see another failure. I think we should expect to see it, but with the assumption that that will not cause a contagion like 2008, 2009.
Yeah, and I
also,
think we talked about that on with closer to home here in Canada. The risks that we see, and I guess it is financially intermingled, is with rapidly rising interest rates here in Canada as well, those who are highly levered, the current environment, and likely for the next year to two, as rates remain where they are or within the vicinity where they are, there's added pressure on them. Whether you start to see cracks in real estate that we talked about in the last podcast, you're probably going to see more of that on the commercial side, and probably filter down into the personal side as well. Leverage is a killer when the cost of capital goes up.
Yeah, it's so, the one of my favorite Warren Buffett isms is, and I think it's just perfect in this situation, is, you only figure out who's swimming naked when the tide goes out. And, the tide has gone out this last year, and we're starting to see, who is taking too much risk, who has too much leverage, who is mismanaging their assets. And, to your point, Clark, I think that's going to continue. So, we've got to be prepared. And I think, hopefully we're through the worst of it. And I think the, positive thing is that, the regulators, the Fed, the, FDIC have come in and provided at least, some sort of backstop for more runs on the bank, but that's not going to solve everyone's problems. So higher interest rates are here to stay, and businesses, forget banks, but businesses as a whole need to watch their leverage ratios, just like our messaging to clients is you've got to be prepared for higher interest rates. You've got to be behaving conservatively as the economy slows down, and the same assumptions we were making in 2020, 2019 probably aren't gonna hold true in this higher interest rate environment. So
but let's have a discussion about that, because you've seen since our last podcast, you saw it today and 2 weeks ago, the Bank of Canada has paused. The Federal Reserve today raised interest rates by 25 basis points. 2 weeks ago, that was almost a shoo-in that was going to be 50 basis points. You're seeing this kind of tide roll over right now where, I think we probably agree that we're in the 8th, 9th inning of this interest rate tightening cycle. And even the tone out of these central bankers has significantly changed over the past month, in particular over the last 2 weeks. So, even the market now is discounting that the end of this year, you're going to start to see interest rates cuts. It's a fluid situation. The tone, again, just let alone today, Jerome Powell previously said, we are going to raise interest rates. He changed that to May, and we're continuing to watch incoming data.
Yeah.
That word alone is a lot different than where they were a month ago.
Yeah, leave it for a bank failure to, break the back of inflation, I guess, and, get us off of this rate rising cycle. I think an extended pause through the rest of the year would probably do the economy a lot of good, and certainly the market would behave, you'd expect, somewhat favorably in that scenario. So,
Jay, you brought up Warren Buffett, and I think, if we look at, 30 years ago, the savings and loan crisis, we look at 2008, 2009, we look at the current issues we go through. I think he's a really good reminder, though, and let's take a step back again and look at what we do from a portfolio management perspective, what he does in managing, Berkshire Hathaway with, it's difficult when we're going through these things to continue to focus on the long run and we just spent 20 or 25 minutes talking about an issue that probably 5 months from now, will be a little road bump in the long-term scheme of things. And maybe a really good time to kind of look at, some of the approach that he takes as well.
Totally. So we all read his annual letter that came out a couple of weeks ago, which is always filled with wisdom for any investor. I think no matter what tilt your strategy is, we can all learn from Warren Buffett, and his track record is maybe second to none, but always synthesizes what's going on in the market in a very easy to understand few sentences or concepts. So I think when we're going through these episodes, like you said, Clark, it's easy to forget all of the long-term success that the market does create for us. And I think one of the important pieces, as always, is not to get blown off track by these scary moments, by the desire to react to a bank failure that probably has very little to do with the portfolio that you're invested in, or your personal financial situation. Craig, any thoughts on how to kind of work through this current period?
Well, if you're going to use Warren Buffett as kind of the flagship for investment success, he takes two approaches. He buys a business outright, or he buys a business in the public markets. And both he's seen successes and failures in over time. Certainly, he's seen far more successes, and that's the way to think as a business owner. And if you're investing in public markets, such as stock markets, such as bond markets, I think the approach that he has really goes against this theory of efficient markets, because at times markets appear to be efficient, but you get into an environment such as this, and good businesses can be indiscriminately sold and present a buying opportunity. And that's the way Warren Buffett approaches things. That's the way any smart investor should look at it. We all look at a flyer and pick up groceries when they go on sale, but rarely do investors have that mindset of saying a good business is on sale. Now it's time to accumulate.
And he announced, I think just either this week or last week, that he was buying more stock in Berkshire Hathaway as it kind of got dragged into this whole banking crisis, being in the financial sector. And as it goes on sale, he's going to be acquiring more. And he's also been making some fairly big purchases through Berkshire of Occidental Petroleum, which is another stock within the oil and gas space that has gone down in price quite significantly over the last few months. And taking that long-term approach, recognizing when things do go on sale, right, is always important. I think one of the little nuggets of wisdom that he explained in his recent annual letter was I think super good in terms of evaluating his own kind of report card over the last, I think, 70 years since he's owned Berkshire. And, he really suggested that his, or the Berkshire's, track record was attributed to basically one very successful investment every 5 years. So he said there's basically 12 investments over a 70-year period that he can attribute most of the success of Berkshire Hathaway to. And there's been failures, there's been companies he's invested in and owned that have gone out of business. And through these periods of 2022, maybe 2023, when the markets get shaky, you're going to expect some businesses to fail, for some of his investments to do poorly. But again, extending the time horizon, looking more at the overall success of his portfolio holdings. It's when you take the lens that he does, and again, he highlighted like the example of Coca-Cola, which I think he bought for $1.2 billion or something like that back in 1994. And this last year, the dividend that he received from that purchase, without adding any shares since then, was close to $1 billion. I think it was like $800 million of dividends just in 1 year. So basically, every 16 months, he's getting the full purchase price of his investment back in dividends. And that doesn't say anything about the total value of his Coke position, which is something outrageous, like $200 billion against a $1.2 billion purchase price. And that's buying Coca-Cola. Like, this isn't, taking some, imaginative, highly sophisticated, investment, or putting a trade on that needs, constant buying or selling. It's really just believing in a good brand and holding it for a really, really long period of time.
And I think, what I take out of, Buffett and just the letter that we read recently is just his patience and what's made him so successful. The things that you said, a few really good investments, but his ability to remain patient, kind of ignore the short-term noise, like some of the things that we're going through now, we've gone through over the last couple of years, and really remain focused on the long run. He says, they don't really even look at the economy, in any given quarter or any given year. And I just as we're talking, I just pull up this letter, and I think, a really good quote that he made in there, refers to Charlie Munger, his partner. Charlie and I plead ignorance and firmly believe that near-term economic and market forecasts are worse than useless. Our job is to manage Berkshire's operations and finances in a manner that will achieve an acceptable result over time and will preserve the company's unmatched staying power when financial panics or severe worldwide recessions occur. And I think it's really that kind of focus, whether you're managing a company like he is, managing your own personal affairs, or as we do, manage client portfolios to really stick with.
Yeah. And you mentioned one word there that always sticks out, and we've mentioned it before. Really, the rarest commodity in investing is patience. There's a time at times like this is to emotionally get involved. And a lot of that's based off of short-term noise, headline news, the media. Probably without the media, we wouldn't be having this conversation about bank runs. You probably would. Maybe Credit Suisse's situation a little bit different. But again, look at Silicon Valley, tying it back in. It wasn't toxic assets. They were invested in treasuries backed by the US government. What caused it was probably sometimes short-term emotional decision-making in conjunction with some media headlines. So it's at times like this that patience is probably the most valuable asset that you can have.
Patience and a bit of optimism helps. It seems like Warren's always, expressing endless optimism, even when, the country's in dire straits, 2008, 2009, when, no one was willing to, take the optimistic viewpoint. And, he says time and again that, a lot of the success that he has, he can attribute to, just being an investor based in America, where you've had this, growth engine and this, dynamic, economy that's, paved the way for a lot of this. So I think we can always learn something from Uncle Warren and apply it.
Grandpa Warren.
Grandpa Warren in the current environment. So I think with a lot of the feedback we've had, we're going to do our best to keep things, relatively short here. But any closing thoughts from either of you?
Well, I just looking through this letter again, I think there's something I just picked out on page 10 that you guys should cut out and frame, I think, and it goes back to Grandpa Warren. A lot of people aren't aware that, Warren's 92 years old. His partner, Charlie Munger, is turning 100 this year. He's 99. Yeah. And in this letter, I love this quote from Warren Buffett as he refers to his older partner, Charlie Munger. And I think you guys have heeded this with what we've done over the last number of years of working together, but find a very smart, high-grade partner, preferably slightly older than you, and then listen very carefully to what he says.
So we're not going to reference age on this podcast, but
I'll note actually as I do the math. I'll note as I do the math, Craig, that the age difference between Charlie Munger and Warren Buffett is the same as between you and I.
And I just had a birthday on Monday too.
I'm the one with a little bit, I don't want to call it gray hair, but maybe whiter hair on the sides here. So as I said, you guys have heeded that advice over the last few years, and I see it would frame very nicely page 10 of his annual letter.
the nice side of that equation is the younger guys like us, we can introduce technology like a podcast to the Grandpa Warrens of the world.
Very, very true. Yeah, as you know, I've had a hard time kind of grappling this, but we're getting it.
Well, I look forward to podcast number 4,000 when you're 99 years old and still managing investments with us, Clark. So,
alrighty.
Well, without anything else, we'll leave it at that. And again, thanks for all the feedback from everyone. Keep it coming. We look forward to seeing you next time.